Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenevec on Bloomberg Radio.
So, as you know, as we've been reporting here at Bloomberg, U.S. and Israeli joint strikes continuing across the Middle East. This is for a third day as Iran continued to fire missiles at countries around the Middle East in response to that attack, causing major disruptions and a surge in oil prices, with Qatar and the UAE lobbying allies to help persuade President Trump to reach for an off-ramp. And earlier this morning, Tim, we heard from a lot of important voices on all of this.
Yeah, U.S. Secretary of Defense Pete Hegseth was joined by Dan Kane, the U.S. Chairman of the Joint Chiefs of Staff. They spoke at a briefing at the Pentagon. They took questions. Also, just a little before noon, Wall Street time today, President Trump, at a medal ceremony at the White House, he addressed the U.S. and Iran.
Today, the United States military continues to carry out large-scale combat operations in Iran to eliminate the grave threats posed to America by this terrible terrorist regime. We have the strongest and most powerful, by far, military in the world, and we will easily prevail.
The mission of Operation Epic Fury is laser focused. Destroy Iranian offensive missiles, destroy Iranian missile production, destroy their navy and other security infrastructure, and they will never have nuclear weapons.
The combined impact of these strikes, swift, precise, and overwhelming, has resulted in the establishment of local air superiority.
Our ambitions are not utopian. They are realistic. This is not Iraq. This is not endless.
Whatever the time is, it's okay, whatever it takes.
Again, that was President Trump at the White House today around noon, Wall Street time. We also heard from U.S. Defense Secretary Pete Hegseth there, and also Dan Kane, U.S. Chairman of Joint Chiefs of Staff. That was at a morning briefing from the Pentagon. As we said, U.S. stocks seem to be taking a lot of this in stride following Asian and European declines earlier. We did see the U.S. dollar rally. We've seen Treasury yields here in the U.S. also moving up on inflation concerns. And of course, gas prices surging as well. There's been a lot in terms of markets. Curious to see what our next guest has to say, because it does feel like there's a lot continuing to come at investors. Michael Contopoulos is Deputy Chief Investment Officer at Richard Bernstein Advisors. They have about $17.5 billion in assets under management, that as of the end of September. Mike joining us right here in studio. Good to have you here.
Nice to be here.
It's been an interesting 2026 already, and it just feels like the invasion, the attacks on Iran kind of add another layer of risk to what's already been a pretty fragile market. So I am curious, before we get into portfolio management and what you should be doing, it feels like the first question that needs to be asked is what's really changed as a result of what happened over the weekend?
Yeah, I mean, I think it's too soon to tell exactly. I think you hit the word of the day, the nail on the head, which is uncertainty. Uncertainty has really been a staple, I think, for the last 18 months or so, is going to continue to be a staple. I think gold is reflecting that and has reflected that over the last year and a half. But I do think, listen, wars in general never really are disinflationary or deflationary. I think the bond market is picking up on that at the moment, whether that be because of the obvious oil and natural gas disruptions, or whether it be more due to supply chain issues. It's hard to make a case how what we saw over the weekend is going to lead to deflation or disinflationary forces. And
especially going into it, there were inflationary concerns.
Well, that's the thing, is that, I think even without what was going on with Iran, you've been seeing inflation start to tick up pretty meaningfully. Remember, core PCE is what the Fed cares about. And core PCE bottomed in April of last year. You look at ISM input prices today, you look at the PPI data, it's all suggestive of higher inflation, not lower inflation. And so this just adds another wrinkle to that, which I think the bond market is getting right? You started off with the flight to quality and lower yields, and that quickly reversed course, and now you're seeing higher yields, and I think that's the right reaction.
Can we extrapolate this to midterms and in an environment where voters care about the economy, voters care about prices, they care about inflation, and what this war could mean for a change of control in Washington? Not at the presidential level, of course, but maybe in the House, maybe even some are saying in the Senate.
Yeah, I think ultimately what matters for markets is less politics and more what the trajectory is for liquidity and earnings. And so to the extent that, how does it matter to markets? I'm not sure the midterm elections even matter all that much. I think earnings growth is reasonably strong in the U.S. It's certainly expanding globally pretty dramatically. What happens with the midterm elections is not going to affect what happens with European earnings and emerging markets, ex-China earnings. I actually don't think politics are going to have a huge influence on rates either, which I know is probably maybe a controversial statement in and of itself. But I think the markets are smarter than what's going on with politics, and investors will be investors. And the midterms are going to prove to be much less exciting for markets than maybe what most expect.
What could be exciting in a negative way is some kind of crisis. And I just do feel like the drumbeat is expanding. Former Goldman CEO Lloyd Blankfein speaking in an interview with Citadel's co-chief investment officer about how he can smell a fresh crisis brewing and sees similarities, parallels to the mortgage crisis. And then it was just Jamie Dimon that we heard from about a week ago, and we're going to hear from him in just a moment too, live on our air, warning of parallels to the financial crisis. What are the major risks? Which seems like a stupid question coming off a weekend where we have seen the U.S. and Israel attack Iran, and we see again unease, unrest, if you will, in the Middle East. What are the major risks? And is it, we've seen credit spreads widening a little, like we see things percolating, and yet that doesn't necessarily mean crisis.
Yeah, I do think that the stage could be set for credit weakness. We've been saying that admittedly for probably a little longer than what it's taken. About 18 months ago, we started talking about the illiquidity risk with private credit. And we're starting to see that actually, happen over the last few weeks and over the last few months. I think absent from, Middle East tensions and sort of war, and I'll talk about that in just a moment, I think the credit space does pose a bit of a risk here. Not so much from mass defaults and that causing a recession and any sort of contagion similar to the global financial crisis, but more from the perspective of having these very illiquid products. And what do you sell when you can't sell what you want to sell? You sell what you can sell. And
so
that can sometimes beget a crisis in and of itself.
Who gets hurt in that process?
Well, I think certainly private credit holders, but also just credit markets in general. I think if that comes at a time where you have higher inflation because of geopolitical risk and higher rates, that can cause meaningfully wider spreads and credit risk as well.
Something that's not lost on us, and we talk about this all the time, is that this is happening at a time where certain people want retirement accounts open to private credit.
Yeah.
And the idea that, everybody should have an opportunity to invest in what many argue is an opaque asset class. How do you view that?
So it's interesting. Rich Bernstein, who you all know, and is of course the founder of RBA, wrote an interesting report several years ago about what sort of are the makeups of a bubble. And one of the key makeups of a bubble is democratization of markets. And I think that's what we're seeing here. That's essentially what you asked him, is sort of the idea of private asset classes within, retirement accounts and these sort of things, alts and all this, in illiquid asset classes within retirement accounts is democratization, just like, the gamification of trading has been. And at
the end of the day, the people who and correct me if I'm wrong, Carol, but it seems like the people who want this in retirement accounts are the ones who sell it.
Yeah.
And the ones who, would benefit from a larger market of people or entities buying these assets.
It feels like there's a lot of money to put to work, and they're searching for more markets to put it to work. And
it's a good way of saying
that makes me a little nervous.
Yeah, I think you mentioned Lloyd Blankfein earlier. He had a good quote about this and how many of his peers out there have made substantial sums of money doing what they're doing, and now they're trying to even grow that more. And what's the real need for that? Those were Lloyd's names, words, not my own. But I do think that is an interesting point. But listen, this is an industry. The asset management industry is one where you get paid to grow assets and perform, right? We focus on the performance side and let the asset growth take care of itself. But it's hard. It's easy to see how those can get, those objectives can get muddled.
Michael, just got about 30 seconds here. This moment in time, how do you suggest investors should be investing? Should they be making adjustments, thinking shorter term? What's your thoughts here?
Certainly not shorter term. I think investors need to think like investors and think over the long term. Currently, we want to be underweight really expensive excess in the markets, investments that are driven by liquidity. We think liquidity will tighten more. That means basically underweight long duration assets, speculative U.S. technology. China, we would put in that boat, and overweight, shorter duration assets. Companies that pay dividends currently value short duration, high quality fixed income.
All right, going to leave it there. Come back soon.
Thank you.
Please, please. Michael Contopoulos, Deputy Chief Investment Officer at Richard Bernstein Advisors, joining us right here in studio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, it is the big story. It is the backdrop, not just for the trade today, but informing all of our coverage. And that's the war with Iran. Strikes across the Middle East continue for a third day. The president said the U.S. will do, quote, whatever it takes in Iran. He didn't rule out ground troops.
Nope, he did not.
In fact, gas prices surged after Qatar shuts the world's largest LNG export facility. And Carol, limited flight operations are resuming after earlier disruption. You actually see airlines taking a hit today.
Yeah.
After some of them change their service in the region, and then also the higher fuel prices weighing on that.
I think we're trying to figure out, I think the world is trying to figure out the way forward, whether this is shorter term or longer term duration in terms of a conflict. Mona Yacoubian is Director and Senior Advisor of the Middle East Program at the Center for Strategic and International Studies. Great to have her back here on Bloomberg Businessweek Daily. She joins us from Washington, D.C. Mona, good to have you here. I feel like it's so weird. It feels kind of calm today, and yet it is very weird considering what has happened over the weekend and continues to happen over in the Middle East. Give us kind of top of mind for yourself right now and how you're thinking the situation. Does it go on longer term? Does it go on shorter? Like, how are you thinking about it?
Yeah. Thank you. Well, it's anything but calm in the region. I mean,
Yes.
I think we've seen a significant widening of this conflict by pretty much any metric. You all mentioned, for example, you have energy infrastructure that's now been hit in various Gulf countries. This was considered a red line, and yet the Iranians have gone forward. We see proxies engaging, Hezbollah actually engaging overnight, then prompting a fairly significant Israeli offensive that is now ongoing in Lebanon. And there's even the potential for an Israeli ground incursion into Lebanon. And you're seeing the Iranians continue to respond in various ways, including sending fighter jets to Qatar that then had to be intercepted. So, I mean, by pretty much any metric, this conflict is widening. It now is embroiling Israel plus 10 Arab countries, and you're even seeing Iranian strikes hit as far as Cyprus, where they've gone after a British military base, not once but twice. So I think for Iran, they are pulling out all the stops. I think that they see the stakes here as existential. And so they're going to widen and exact as much cost as they can in the hopes, perhaps, that the U.S. and Israel and others will then look to potentially de-escalate. I don't think this is a days-long engagement. I think we're talking weeks and maybe even months.
Weeks or months. You mentioned what Iran has done in response just in recent days. And I think one thing that's notable is the allies that the U.S. and Israel find more so in the Middle East than in Europe, for example. I'm curious who Iran has in its corner. Can it rely on any of its partners, China, for example, to help at all?
We've not seen significant support beyond perhaps rhetorical support from Russia and China. We don't know, of course, what's happening covertly. But Iran actually has managed to alienate the Gulf, which, frankly, up until this latest conflict, the Gulf had actually been working hard to de-escalate tension and to insist that there should not be war against Iran. Now, because of Iran's reaction and the ways in which they have ensnared these various Gulf countries, you're seeing Gulf countries galvanize their support against Iran. I'm not saying we're going to see military action by the Gulf, but it's very clear that Iran is really alone. It has its proxies, but even they, again, are weakened. Let's wait and see. I think the other shoe to drop will be if the Houthis choose to engage once again, and that could actually further snarl commercial and shipping traffic in the Gulf and around the Bab el-Mandeb, another key choke point in the region.
How weakened are Iran's proxies, and how deep do they go? It does seem like a lot of leadership, official or otherwise, has been taken out, but how much do we know about that, which will speak to their ability to come back?
Well, we've seen the so-called axis of resistance that is comprised of Iran's proxies very much unraveled. Hamas, very much on the back foot. Hezbollah, yes, they mounted, frankly, a rather tepid drone and missile strike on northern Israel. No damage even from it. We haven't heard much from Iran's proxies in Iraq. They've been relatively quiet. Even the Houthis have remained on the sidelines. Now, I say that with some trepidation because I do think we could see the Houthis engage. But I think it's fair to say that Iran's proxies have really been substantially cut down to size, and they really don't pose the same threat that they had, let's say, certainly before October 7. Again, I would put one caveat, which is the Houthis, and they really could engage and snarl Red Sea shipping and go after U.S. and Israeli targets. That is something I think we could see in the coming days.
Mona Yacoubian, Director and Senior Advisor of the Middle East Program at the Center for Strategic and International Studies. She joins us from Washington, D.C. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Block's recent layoffs prompting not just worry about the job market, but also deep cynicism about how corporate leaders will frame an uptick in AI usage. Danny Moses mentioned it. He was like, hey, there's not one executive out there right now who's not thinking to themselves, can I use AI as a way to reduce my workforce? Can I blame it?
And listen, to be fair, I think most leaders that we talk to, when you push them a little bit, they'll say, of course we're thinking about it. We're trying to understand its impact, what it can do for our workers. How does it help? How does it aid them in maybe some of the more tedious tasks, to open them up to do things that maybe are more meaningful to the company, especially in terms of the company's top and bottom line. So I think we are very early in. Some say first inning. I talked to somebody this morning, said we're in the third inning, which I thought was surprising. But I think we are early on in terms of understanding the true impact.
You know, you and I are going to be at Bloomberg Invest tomorrow. Mm-hmm. It's a conference that is about finance. It's downtown. It's, Wall Street adjacent.
Right in the heart of the financial sector.
It is in the heart of the financial district, Wall Street adjacent. And the one thing that I've been thinking a lot about is how the conversation has shifted. Because I did a panel there last year about AI and a tool that people could use. How the conversation has shifted from AI being this tool from that a year ago now to being this layer that everybody's using all the time. And my panel includes Marjorie Janowitz. She's the Chief Revenue Officer of Mistral AI. So they're a frontier model provider. So like OpenAI or Claude, paired up with Shobit Varshney, who's the global head of AI at Citi. So if you're interested in that conversation and about how financial institutions are using it and building for it, check that out. It's happening just about 8:30 tomorrow morning. And you can check it out on the Bloomberg terminal.
Lots of great conversations coming from Invest. Right now, we have a good conversation we want to get to. And this has to do with Block's recent layoffs, prompting not just worry about the job market, but deep cynicism about how corporate leaders will frame an uptick in AI usage, so-called AI washing. We got there rather quickly, using AI as an excuse for drastic job cuts, now front and center, as Tim mentioned, as critics highlight Block co-founder Jack Dorsey's management decisions in recent years, including a pandemic-era hiring spree. Feel like we are still trying to figure this way out. And there's a lot of people weighing in on it.
Yeah, one of those people weighing in, Marcelo Lima, managing partner at Heller House. It's a firm that calls itself a, quote, value-oriented investment management company. It invests in companies with, quote, low fundamental risk and high potential upside. Marcelo joining us from Miami. Marcelo, welcome, because you were one of those critics last week. When Block announced its layoffs, you posted this on X, quote, Block's 40% reduction in force is the new Citrini fake narrative. Everyone will assume Jack Dorsey is the, quote, greatest of all time, is doing this because AI. He's not. Block has been massively bloated for years. Don't forget, Jack was head of Twitter, When Elon took over, he fired 80% of staff within 5 months, and the product got better. That was before Gen AI and Claude Code. So is this about AI at all, or not at all about AI?
Yeah, Tim, thanks for having me. I think there's no question that AI is going to make companies more efficient. We heard from Jamie Dimon last week talking about moving people from certain jobs to other jobs where their skills can be better used as AI takes over certain tasks. But as far as Block is concerned, I think it's hard to argue that this company wasn't massively bloated. And I think, in fact, even after this reduction in force, they're still above about 50% more than where they were in 2019. And the company really should be a lot more efficient if you compare them to other global players in fintech.
Well, they didn't have a few things. They didn't have Afterpay in 2019. It was still called Square back then. The company's changed a lot since then. What about instead of using a fintech as a corollary, we use a company like Anthropic as a corollary, a company with more than $300 billion in valuation in the private market and just several thousand employees. That's sort of the AI angle there. Does that make sense?
Yeah, I think it does. In fact, I did a ranking of Block a few years ago where you could go and look at how much in gross profits different companies generated, even from different industries, because that is really the metric that matters for Block is gross profits. That's really their top line. And then how much of that drops to the operating income line. And Block was dead last, almost, next to a cruise ship company. So across different industries, including software, fintech, et cetera, Block was really shown very poorly in terms of efficiency. They were eating up a lot of dollars between those two lines, gross profits and operating income, in things like R&D expenses, general administrative, sales and marketing, et cetera.
So if you were sitting down with Jack Dorsey, what would you be asking him? What do you want to know from him right now?
Well, I'd say, Jack, is this reduction in force really the most that you could have done? If you could pull an Elon here, how far would you go? And is there more to come? Because still the margins that they're guiding to next year are about 26% EBIT margin compared to gross profits. But a company like Adyen is at 69%. A company like Nubank is at 66%. PagSeguro is at 34%, StoneCo is at 43%. So they could be even more efficient than they're projecting for 2026 now after this reduction in force.
Do you think, just based on what we saw in the share price on Friday, jumping almost 17%, 21% at its highs intraday, but finishing with a 17% gain, another 0.5% higher today, Marcelo, that you think that is maybe, I don't know, what message does that send to Jack Dorsey? I mean, obviously, the investors are behind it. Are they misreading it, though, in your view?
I think short-term stock price moves have a lot of noise. There could be short covering in the stock. I don't have the short data right in front of me right now. But there's no question that this increases the probability of them actually achieving that metric, which is earnings per share that investors actually want to see. A few years ago, I think it was almost 2 years ago to the date, I sent Jack and Amrita an email with a projection showing about $4 in earnings per share for 2026. I think they're going to deliver, according to their guidance, $3.66. Of course, they're probably trying to beat that. So they are actually now, finally, after this reduction in force, delivering the high end of my estimate from 2 years ago. And frankly, they should continue on this path, and hopefully they do. And I hope shareholders enjoy that ride, because it's better late than never that the company should become more efficient.
Are you a shareholder now?
I am not a shareholder now. I was a frustrated shareholder for many years, and I kept trying to get in touch and engage the company on this topic of becoming more efficient, showing them this is what your valuation will be if you deliver these numbers. This is what the IRR between the current share price and the future share price could be. And it was not very fruitful, so I moved on.
Would you invest in the company again?
Look, if I have proof that Jack and Amrita have really changed their stripes and they really are focused in generating shareholder value, then yes, I think I would, because I do think Jack is a visionary. He's a great product guy. But I do think that the company was really not run for shareholders historically, and I would like to see if he could marry both things, be a product visionary, be good at executing, and be a good steward of shareholder capital, then this company could do extremely well for shareholders as well.
Yeah, it's kind of interesting, I guess, to have this happen on top of the Citrini research, this nightmare of kind of mass unemployment, and that certainly spooked the markets when that report came out. We just talked, with Danny Moses, founder of Moses Ventures, of course, the Big Short fame, if you will. But this idea that some of these things coming out, and I'm just going to go to the Citrini research, that maybe it's just, a longer term view of perhaps where these things are headed. Because if you do talk to a lot of executives, they're very careful in terms of the impact on the company, but it's hard to ignore that things are changing. When it comes to the impact of AI, how do you put it kind of in its proper place, or what is your view on what is the AI trade, the AI scare? What is the proper place for investors? How should they be kind of reading into it?
Carol, I think every investor should try to vibe code with Claude and with Claude Code and Codex as well from OpenAI. They're fantastic tools. I've been using them a lot. I used to be a software engineer earlier in my career. And it's not the panacea that it's sort of this magic wand that everybody claims it is. Oh, I one-shotted this or that application. It's actually pretty complicated, and you have to guide it a lot. Yesterday, I spent a lot of hours coding a plugin for Excel that I want to do certain things, looking up a certain API, et cetera. So this still requires a lot of guidance. Yes, I do understand the science fiction future, but I think some of the smartest voices now are really actually the guys trying to disrupt the incumbents. And those are the top venture capitalists in the world, people like Mark Andreessen from Andreessen Horowitz, right? And if you listen to what his firm is saying, these guys are in the business of disrupting incumbents. They are saying that AI will be actually a tailwind to the best enterprise software companies. So when the guys saying that, and they have a vested interest in disrupting the incumbents, right, maybe we should listen to that signal, right?
Yeah, there is certainly something to that. I do want to be fair. Jack Dorsey did take to social media on Friday and responded to one critic who pointed to the accusations of bloat that have dogged his companies. He acknowledged the company is overhired during COVID and operated inefficiently when he ran Square and Cash App as two separate businesses. He went on to say the Block had corrected for all of that and that it now aims to generate more than $2 million in gross profit per employee, quadruple what it was generating pre-pandemic. And then Block's chief financial officer said in an interview with Bloomberg, "We are taking bold and decisive action here, but we're doing it from a position of strength." So just wanted to share that with everyone as well. Hey, fun to catch up with you, Marcelo. Things to think about, certainly, as we kind of make our way through this, and will be, no doubt about it, not only for months, but probably years to come. Marcelo P. Lima, he is founder and managing partner of Heller House, joining us from Miami. This is Bloomberg.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, speaking of those higher energy prices, I want to bring in Cole Smead, CEO and portfolio manager of Smead Capital Management. He joins us from Phoenix. The Smead Value Fund has more than 20% of its holdings in the energy industry, including APA and Conoco as top 10 holdings. Diamondback and Occidental are in there as well. Cole, what is your reaction, at least from a markets perspective, and then we'll get to the energy side of this in a minute. What's your reaction to the events over the weekend and ongoing in Iran?
Yeah, and thanks for having me. Good to hear from you guys and see you as well. I would just say to begin with, you have to remember, Tim, that you're starting with an S&P that owns less than 3% in energy. To quote the Monty Python for the S&P 500, "'Tis merely a flesh wound" from a sector perspective. And so I think we're in an environment where people have really not cared about this kind of stuff. If you go back to the last spring, the idea for most investors, if they did touch or think about energy at all, was, well, energy is going to get drilled into the ground because we're going to have a recession tied to tariffs and the oil price is going to be low. And therefore, there's not much concern other than we know OPEC's going to increase obviously their production. And as you fast forward through the year, there were other conversations with that. Venezuela fell into that same, like, Let's scare everyone out of the energy space, at least, temporarily in rhetoric. And what we wake up with a world is where nothing in the last 12 months really makes any sense to anyone other than they're waking up with a much higher oil price than they would have expected at any point during that, and a tension that seems to be so much less easy to solve than Venezuela. I think one thing that has to be mentioned is OPEC is effectively liquidating its excess capacity, not dissimilar to how other industries, when they go into liquidation. 3 to 4 years ago, if you look at the tanker business, which is another whole subject in this, the tanker business was liquidating where they got such low cash rates per day that they would not reorder or buy as many tankers as they had in their fleets. And so we're seeing a liquidation of the global oil market for its excess capacity. But the question remains, Tim, isn't the future fairly bright? And don't we have more demand and needs? And so how are we going to meet 10 million barrels of new demand that shows up in, say, 10 years when OPEC effectively has 1 million barrels of excess supply left? And that is it, my friends.
Well, I don't know. I mean, how do you bring the U.S. into this and a world that, Cole, is increasingly also embracing alternative energy? So I'm just curious, whether it's, go all the way from green energy to, nuclear energy in different forms to meet the demand increasingly. As you say, a lot of it to do with AI, but I remember having a builder in and, doing massive projects in there saying that increasingly everything's electrical. So you've got to figure out how to power it. So I'm just, as we continue to embrace more forms of energy, you still see that there will be the demand and the uptick when it comes to fossil fuels, and that will lead to higher prices.
Yeah, I mean, we're going to need every form of energy. That's not the question. We're going to need a lot more of it because that's the nature of human progress. Go ask Elon how much easier it is to sell EVs without a subsidy. So I think that's the other question that has to be asked is what policies grow the best without subsidy? And frankly, oil and gas is just a place that grows easily without subsidy. So if you look at this, I mean, let's use the United States. We are exiting our position of leadership in growing global supply. We are the largest oil producing nation in the world, 9 million barrels a day. We grew to that from almost nothing 20 years ago. And we have decided, stupidly might I add, but we have decided that we want low oil prices. And so what happens when you believe that you'll have low oil prices? You scare your producers from producing more. Versus at times like the 2010s or coming off the peak oil theory of 2008, and investors thought we were going to have high oil prices forever and ever, amen, and that the emerging market consumer was going to be the drumbeat of that. And what we ended up finding was we could grow a lot of production off that. The only way America will produce more oil into the future is with high prices. And what the Trump administration has tried to do is they have tried to effectively use the bully pulpit into making people believe we'll have lower energy prices. It just ain't seeming to work in as much as it has, say, compared to last April.
So are you ready to go for higher energy prices and higher inflation and a higher rate environment, if that's what it takes?
Well, it's a good question. You got to remember Newton's third law, Carol, says that for every action, there's an equal and an opposite reaction. And so let's just run that path. Let's take the path of we're going to have higher energy prices. That'd be very tough for the Fed to deal with because obviously, you can't do anything about that. It's like the fly in the ointment, if you will. Except that if that happens, that's not good for stocks, particularly historically. If you go back and look, long duration stocks, what are the longest duration stocks out there? We call those tech stocks nowadays. And so the great part about being the 10-year treasury is you're not a stock. So what was the initial reaction yesterday in the bond market? Well, the initial futures reaction of the 10-year was yields down, okay, with the NASDAQ down nicely in that futures move. So I say that because I don't think the government has as much trouble if there's something, arbiting that 10-year and the stock market doing poorly would actually drive long-term yields down because it's a place to hide. And so the idea that yields go up, that automatically is just terrible for the bond market. No, I would say people looking at a 10-year at 4 might be begging for 4% yield in a bad stock market.
Hey, Cole.
The only thing is, I will say, U.S. government doesn't necessarily want yields to go up too high either, right? Because if you look at the deficit, that just continues to grow and grow, and that becomes...
They don't. But again, why would investors be willing to accept higher inflation? If they get punished in the stock market, they'll just accept less volatility. And that's what happens often in bad markets.
Hey, Cole, we only have 30 seconds left, but the S&P 500 is flat right now, and I would not have bet that that would happen today. Why such a muted reaction? Very quickly.
People are just fading the risks. They want to be long. They don't really care. I mean, Tim, who's going to go out and pay capital gains on taxable assets after what they've seen the last 5 to 7 years? The history is they always deal with the tax situation when things are much worse. And so we're seeing this investor that is right now saying, we don't really care. What the wise man does in the beginning, the fool does in the end. We'll find out whether this is foolish, I guess.
Hey, 10 seconds. You buying more energy names? Just real quickly.
It's a great environment, and people hate the long-term story. So we're very comfortable in our seat.
Okay. That sounds like no, but it sounds like you like what you've got. Good stuff. Cole Smead, Chief Executive Officer, Portfolio Manager at Smead Capital Management.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.